If you have ever been curious about how the stock market works but felt overwhelmed by all the complex jargons and the complexities, you, my friend, are in the right place. Hello everyone and welcome to our beginner's guide to the stock markets. My name is Madhur Singh and in today's video, I'll walk you through the fundamentals of the stock market, the regulations that keep it running smoothly and the key trading concepts that you need to know to get started. Now, I understand that the stock market can be a tedious task to learn. But let me declutter today's session into three different parts. Number one, why should you even consider investing your money in the stock market? Then, what exactly is stock market and how does the stock market work? The key terminologies involved and so on. Finally, I would also talk about choosing the right broker. So by the end of the session, you will have a solid understanding of how to begin your investment journey in the Indian markets. So stay till the very end because this video is going to be an informative one. Now an obvious question comes to the mind is, why should you even consider investing your money in the markets? Chalo, let me ask you a question. If I give you 10 crore rupees right now, or give you 1 rupee that is doubled every day for the next 30 days, but the catch is that you will get the money after 30 days, which one would you choose? With all the logical thinking, you would say 10 crore right now, right? That would be your answer. So let me choose the other one. Let's do some maths here, okay? So let's say at day one, you have 10 crore rupees. So at day one, here I have 10 crore rupees that you have chosen. So at the other end, I would choose 1 rupee doubled every day, right? So at day one, I have 1 rupees, very simple. At day two, double of 1, 2 rupees. At day three, double of 2, 4 rupees and so on. So by the end of 7th day, I would have 64 rupees with me. But remember, it keeps doubling every day. So by the end of the month, let's look at day number 27. At day 27, I would have around close to 6 crores 71 lakh rupees, around that one, right? That would be the money that I would be having. Now, doing this for 30 days, at 30th day, I would have with me around 53 crores. And guess what? You would still be having your 10 crores. Now, some things would seem very obvious at the very beginning, okay, 10 crore right now, big number, and 1 rupee is just a very small number. But remember, this is what is known as compounding. The compound effect is hence referred to as the 8th wonder of the world. If you double 1 rupee every day for the next 30 days, you get an amount that is way bigger than what you would have of 10 crores. This, my friend, is compound effect. Now let's talk about another element to why you should invest your money in the markets. So there is something known as inflation. Now hold on, I would explain what exactly this is. So let me explain this with an analogy. Imagine that your salary is like a tree. So every month new leaves come to the tree, which is your income. Now over time the tree grows bigger and gets stronger. But here's a catch. A sneaky thief called inflation is always lurking around, stealing the value of your leaves. Now this inflation is the gradual increase of prices of goods and services over time. I'm just defining what inflation is. So this means that your money buys less and less as the time goes on, which essentially means if you have 100 rupees today, that would not buy you the same things 20 years from now. Now let's say you take some of these leaves and plant them in a special garden called the stock market. Now in this garden, your leaves don't just grow, they multiply. So this magical process is called compounding that we already talked about. So think of it like you plant 10 leaves, they grow into 12 leaves. Next year, those 12 leaves will grow into 14 leaves and so on. So now the more leaves you plant, the longer you leave them, the bigger your garden becomes. So by investing in the stock market, you're not just protecting your leaves from inflation, you're giving them the chance to grow exponentially. So over time, your small garden can turn into a lush green forest, providing you with a financial security and the freedom to pursue your dreams. So let's understand with real money. Let's say you earn 50,000 rupees per month. If the inflation is around 6% annually, your 50,000 today will be only worth 47,000 next year in terms of purchasing power. This means that you'll need 53,000 next year to maintain the same lifestyle that you're living right now. Now let's look at the stock market. So historically, the Indian stock market has delivered at an average annual return of around 12%. So if you invest 10,000 rupees per month, after 10 years, you would have close to around 25 lakhs, assuming a 12% annual return. Now, inflation reduces the purchasing power of your money over time. So if your investments don't outpace the inflation, you are effectively losing money. So investing in the stock market can essentially help you outpace the inflation and grow your wealth over time. Now let's explain how the stock market works. Again, story time. So imagine a bustling supermarket and the owner, let's call him Mr. Patel, wants to expand his business. So he needs more money to buy more products, hire more staff and open new branches. So instead of borrowing money from a bank, Mr. Patels decide to sell small pieces of ownership in his supermarket. Now these pieces are like the shares in a company. He offers these shares to the people who are interested in investing in his business. So when you buy a share of Mr. Patel's supermarket, you become a part owner. So if the supermarket does well, the value of your share increases. Now you have a choice. You can then sell your shares for a profit or continue to hold them and benefit from future growth. Now the stock market is like a giant supermarket for all the companies. But instead of selling products like milk, bread and fruits, companies sell shares of ownership in themselves. So let me make you understand this with the analogy. So the companies, so these are the different shops in the supermarket. The investors, so these are the customers who buy the share of these companies. The supermarket manager, so this is the stock exchange which manages the buying and the selling of shares. In India, we have two primary stock exchanges. One is the Bombay Stock Exchange, which is called BSE. So it was established in 1875 and it's the Asia's oldest stock exchange. It is located in Bombay and it lists over a massive 5,000 companies. Now it makes it one of the world's largest exchanges by the number of listed firms. So BSE has its index called the Sensex, also known as Sensitive Index, which tracks the top 30 companies reflecting the overall market performance. So you would have heard that, okay, Sensex has shot up or Sensex have fallen down. So all these things you've heard in the news. So this is what exactly it is. Then comes the second stock exchange that India has, known as National Stock Exchange or NSE. So it was founded in 1992, fairly new. So it introduced the electronic trading to India. Earlier than this, we used to use paper-based trading, but NSE brought the electronic trading to India. So also based in Bombay, it is known for its modern infrastructure and the technology it uses. So it lists over 1600 companies and is the largest exchange in terms of trading volume. So the Nifty 50 comprises of the top 50 companies across various sectors. Then comes the shopping assistants. So these are the brokers who help the investors buy and sell shares. So just like that, Alice Blue is a stockbroker here. So when you buy a share of a company, you are essentially betting on its future performance. So if the company does well, the value of the shares increases. If the company performs poorly, the value of your share decreases. So that is how it goes. So now let's understand the key components of the stock market. At number one, we have securities, so which includes stocks, which are called equities, bonds, which are debt instruments, then there's something called derivatives, which includes futures and options, and mutual funds, which are traded on the exchanges. So all these combined are known as securities. Number two, we have investors. So one is retail investors. So these are basically individual investors like us. Then comes institutional investors. So these are basically entities like mutual funds, pension funds, insurance companies and banks, right? So they come under institutional investors. Then comes regulators. Now bodies like SEBI, which is called Securities and Exchange Board of India, they oversee the market activities to ensure there is fairness and transparency among the day-to-day activities, right? Now let's understand the key market terminologies that are used on a day-to-day basis when we trade on the stock exchanges. Number one is shares or stocks. So these are basically the units of the ownership in a company. Now owning shares means that you own a part of the company and have a claim on its assets and earnings. Number two is the indices, right? We already talked about it, but it is Sensex and Nifty. So basically Sensex, this is the stock market index for Bombay Stock Exchange and comprises of 30 of the largest and the most actively traded stocks. Then is Nifty 50. Now this is an index for National Stock Exchange or NSE and it includes 50 of the top stocks across different sectors. Now, one important thing here is that these indices serve as the barometers for the overall performance of the market. You must have heard that, okay, Indian markets are down, Indian markets are up. So it's basically talking about Nifty 50 and Sensex. Third terminology is bull and bear markets. Now, you are going to hear about these terms a lot. When we talk about bull market, it is basically a period when the stock prices are generally rising, indicating the optimism and the confidence among the investors. Second is the bear market. So a period when the stock prices are generally falling down, which basically indicates that the market is in pessimistic mood and there is a lack of confidence. So understanding these terms help you interpret the market trends and make informed decisions about where you should make your investments. Then another key element that we are going to talk about is the regulatory bodies and their roles. So the stock market in India is basically regulated by Securities and Exchange Board of India called SEBI. Now you may ask, what is the role of SEBI? So SEBI's primary role is to protect the investor's interest, promote fair practices and regulate the securities market, right? It basically ensures transparency. SEBI set rules and regulations to ensure that companies disclose the necessary information to the public, preventing any fraud or market manipulation, like insider trading and all. You would have heard about it. Understanding SEBI's role gives you confidence that the market operates fairly and transparency. So it's like a trust factor that, okay, you are putting your money in the markets. There should be someone to safeguard that your money is safe or not. So that role is of SEBI. Now let's discuss how would you choose the right broker. So when choosing the broker for your Demat account, start by evaluating their reputation. What Demat account is, I'll tell you in some while. So opt for a broker with a solid track record and positive customer feedback. Compare fees including account opening charges, any annual maintenance and the trading commissions to find the most cost-effective option. So the broker should offer a user-friendly platform equipped with useful research and analysis tools. Now this is very, very important because you would have to trade on a day-to-day basis, right? You would invest your money. So all these analysis tools should be there at your fingertips. Now customer support is vital. So ensure the broker provides responsive and accessible assistance to you. Checking reviews from other users can give you insights into their experience. Lastly, verify that the broker is SEBI registered and adheres to the security standards to protect your investments. So with Alice Blue, you get all these elements and you can trust them. To start investing in the stock market, you need two accounts. Number one is the Demat account, which is also known as dematerialized account. So it holds your shares in the electronic form. Then comes the trading account. So this is used to place your buy or sell orders in the stock market. So you can open these accounts with a registered stockbroker or a bank that offers these services. Now that wraps up our today's session. We have covered some fundamental concepts to get you started on your investment journey. We have explored why investing your money is so important for building wealth and securing the financial future. We also broke down what stock market is and how it works, touching on the key terminologies that every investor should know. Lastly, we discussed how to choose the right broker, which is crucial for getting the best trading experience. I hope you found this information helpful, and remember, investing is a journey. It's basically like a marathon and not a sprint. So if you have any questions and want to dive deeper into any of today's topic, feel free to reach out to us. Stay curious and keep learning. Thanks for joining with me today, and I'll see you in the next video.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.